Welcome back to Frame Wealth Partners, where we decode government tax bills in plain English, minus the lobbyist jargon, but with just the right amount of sarcasm.
And a little Southern twang.
A Southern twang, that's right.
Today's topic, deductions. What changed in the one big beautiful bill, and what could make your tax bill slightly less painful?
Let's dig into what's new, what's gone, and what got a shiny new label, but still smells like bureaucracy.
That I want to see. First, standard deductions. Still big, but now with a twist. Let's start with one deduction almost everyone uses, the standard deduction. OBBBA keeps it big, even adds a bonus for those who are over 65.
That's pretty nice. In 2025, the standard deduction is $15,750 for individuals and $31,500 for married couples filing jointly. That's up from previous years, and it will be adjusted for inflation moving forward.
Great advantage. Now here's the gimmicky part. There's a temporary bonus deduction running through from 2025 through 2028 for older taxpayers. If you're 65 and older, and you get an extra $6,000 if you're single, $12,000 jointly if both spouses are over 65, Jay.
That's not bad. But there's a catch. It starts to phase out at $75,000 of income for individuals and $150,000 for couples. So if you're above those levels, the bonus shrinks.
It's like senior discounts, but with more math and a fewer movie tickets.
That's right. Number 2, charitable contributions. Now comes with a floor, not just a ceiling. Let's move to giving. Starting in 2026, even if you don't itemize, you can still deduct up to $1,000 if single or $2,000 if married filing jointly for charitable donations.
And if you do itemize, there's a new twist. You can only deduct donations above 0.5% of your AGGI. So if you make $300,000, the first $1,500 doesn't count.
Corporations have an even higher threshold, 1% of taxable income. And if you're a high income filer, your deduction can eventually shrink to a max value of about 35% of the donation.
Point is, your charitable heart may still be full, but your refund may not be.
That's right.
SALT deductions. Big changes, big planning opportunities.
That's right. Now, as we talk about SALT, state and local taxes, this is where OBBBA made major changes.
Starting in 2025, the deduction can jump from $10,000 to $40,000 if you're in a high income tax state like New York, New Jersey, California, or Maryland. There's huge opportunities.
That's right. But it's not unlimited. There's an AGI phase out that starts at $500,000, and here's the kicker. Both the deduction cap and the phase out threshold increase by 1% per year until 2030.
So in 2026, if the cap is $40,400, in 2027, $40,800. You get the idea.
Yep. And unless Congress renews it, this bump disappears in 2030, and we're back to the $10,000 cap. So it's a use it while you can.
Absolutely. If you're paying big real estate taxes, or if you're substantially state income tax liability, talk to your advisor now. There may be smart ways to shift or bunch some of these payments.
Number 4, auto loan interest deduction. Yes, it's a real thing. Believe that. So OBBBA has introduced a wildcard deduction up to $10,000 of interest on new auto loans.
Only for U.S. assembled vehicles purchased after December 31st, 2024, and only for personal use. Business use, a whole different ballgame.
That's right. This benefit starts phasing out at $100,000 of income for single filers and $200,000 for married couples.
And here's the fine print. To hit that $10,000 deduction, you need a loan for about $112,000, which means unless you're financing a luxury SUV or a commercial truck for personal use, your deduction probably doesn't land close to that $10,000 number.
No, it doesn't. So yes, it's a nice perk, but unless you're driving a vehicle with its own espresso bar, temper your expectations here.
So what do we do with this information? This is where planning turns into savings. Don't wait till April to see if you get a refund. That's a reaction. What you want is a strategy.
That's right. Run the numbers on itemizing versus standard, rethink your giving timeline, check your state and local tax liability, and if a new car is in the horizon, run the math for the deduction.
Absolutely. These new rules have a short shelf life for some filers. Don't let procrastination be the reason you pay more in taxes than you have to.
So that's deductions: preserved, standard, evolving, itemized, and a few creative twists.
In our next video, we're breaking down tax breaks for America's hardest working folks, those working overtime and on tips. Some long overdue relief coming up.
Subscribe, like, and if your CPA still hasn't mentioned any of this, maybe forward them this video. Just saying. See ya.
Thanks so much.